Hello, hello, hello. Once again, this is Chris Snowdon. You're watching The Swift Half with Snowdon. Thank you for joining me. As you probably know, if you watched before, this is just a half-hour chat show. And as we only have 30 minutes, I'm going to get straight into it because I'm very keen to speak to my guest today get as much out of him as possible. He is Edward Chancellor, who has written the fantastic book, The Price of Time, which is a history of interest rates. And far more exciting than it sounds. The book of the year, if not possibly the decade, I would argue. Certainly very much worth reading. Edward, hello. Thanks for joining us.
Yeah, well, peace be with you.
Now, perhaps you can start off by maybe not summarizing the book, but just explaining the importance of interest rates and what they've done down the years.
Well, I see it really as interest rather than interest rates. Interest being a charge on, well, as I say, it's a charge on time, the price of time. And as I outline in the book, interest is probably the oldest financial institution known to man. It predates cash money, coinage, by at least 2 millennia. And there's evidence from language, from the etymologies of the ancient languages, that interest was probably charged even in prehistoric periods by farmers lending cattle and grain to each other and making a charge on that, because if you look at the origins of the words, they tend to relate, of the word interest, it tends to relate to the offspring of livestock, of calves and kid goats and the like. And then if you look in ancient Mesopotamia, you find where the first cities appeared, you find interest being used on loans, and that those loans were used, as we do today, to buy houses, to finance businesses, local light industry, but also commercial voyages. And what's interesting here is that we see that not only is interest serving its function as a discount rate on the valuation of property, but also higher interest rates were charged on risky loans. So you can see that interest incorporates a price of risk. And as I elaborate in the book, interest is the sort of central pricing mechanism of a capitalist system. It is the capitalization or discount rate at which all assets, whether stocks, bonds, or real estate, you name it, are valued. It's also the rate. It's also the hurdle rate or payback period, as we often call it, that determines the allocation of capital, what type of investments we make. It is sometimes referred to as, in the 19th century, as a reward for saving, or as a reward for abstinence. So interest determines the amount of money that is saved, but it's the price of leverage. So it also determines how much is borrowed. In an international context, interest determines how capital flows, international capital flows. When the core of the financial system, whether Britain in the 19th century or the US in the 20th and 21st century, when interest rates are low there, you tend to have international capital flows growing into the periphery in the rest of the world where interest rates are rising. And then last but not least, interest, as we all know, is supposed at least to be a lever to control inflation. And the thrust of the book really is that modern economists, and in particular monetary policymakers, have only focused their attention on that last function of interest, the lever to control inflation, and yet they've ignored all the other functions. And because they've ignored all the other functions, we have a whole host of problems in the world, which I outline in the book. And I think really, and this is a thought that perhaps is not quite in the book because of the events that happened over the course of this year. What we're seeing now is that because of all these other problems have occurred during the period of ultra low interest rates, the central banks can't even really use the lever to control inflation without bringing the entire system down. So we've got ourselves into a remarkably difficult position because we have ignored or failed to understand the multiple functions of interest. As my friend Jim Grant, the financial historian and journalist, says, interest is the universal price. It is, so to speak, the coping stone in the architecture of a market economy. But it also exists. It exists in all places at all times. I mean, I at one stage I cite history of the Soviet economy, where the economist Janusz Kornai argues that one of the reasons the Soviet economy failed is because they didn't really have a formal interest rate to actually determine the allocation of capital. So part of the failure of communism was actually the failure to have a mechanism, a universal price to determine the allocation of capital.
So the reason that we're in this sort of trap now, in which central bankers are very reluctant to put up interest rates, even though we have double-digit inflation, is because it's going to harm people who've got mortgages. It's going to harm governments because they're going to have higher debt repayments. And it's going to harm what you call zombie companies, or lots of companies, in fact, any company that's in debt. And we've got to the position, you argue, that everyone is so indebted and they're already at the limits of what they can pay back, that if you have interest rates go back to any kind of normal level, suddenly you've got a huge recession, depression.
Yeah, I mean, in Britain, people will understand it pretty clearly in reference to the housing market, because, as you know, that's all the Brits really care about. And say, in this period of very low interest rates that we've just been through, I mean, frankly, it's lasted for 25 years, but the rates came lower and lower. Housing valuations relative to household incomes climbed higher and higher. And that seems sustainable if you could get onto the housing ladder. You needed an upfront cash deposit. But if you could get onto the housing ladder, actually interest payments, mortgage payments as a share of household income in recent years have been near record lows. And at the end of last year, you could borrow at 2% mortgage rate to buy a house. And people tend to pay in their mortgage about 20% of their income, 20 to 30% of their income in mortgage payments. The trouble is, and this is what we saw in September, is that when the market quickly reprices the mortgage rate, as the Bank of England was raising interest rates, we were looking at next year at a 6% mortgage rate. Now, if you borrowed 30% of your income at 2%, you can see that resetting your mortgage to 6% is actually a no-no. But the 6% more bank rate, not a mortgage rate, the Bank of England's policy rate, the 6% is the average post-war. Yeah. Is the post-war average. Now, so you can see quite clearly, just in that simple example, that the resetting interest rates to a normal level would completely crash the UK housing market. And one analyst I read the other day was pointing out that because mortgages are so much larger relative to income today than in the early 1980s, a mortgage rate of 14% in 1980 would be the equivalent today, in terms of payments from household income, of a 3% mortgage rate. So you can see that embedded leverage has made just UK housing immensely more susceptible. And you can say that the same is also true of government finance. With the Bank of England owns roughly 850 billion of gilts, of government debt, and it actually receives the income on those gilt that it owns. But last year, the bank was only charging, in effect, the government by paying interest on reserves, it's called, on the money it issued to buy these bonds. It was only charging 10 basis points. So the cost of government funding came down immensely. But you probably saw the Bank of the House of Lords report last year called "Quantitative Easing: A Dangerous Addiction," in which one of the members being Mervyn King, the former Bank of England governor, he pointed out that a 1 percentage point increase in bank rate and long-term rates would be equivalent now to an increase in the cost of government debt servicing by 1% of GDP. So you can see how difficult it is to raise rates. And we've got, not so much true of the UK stock market, because UK stocks been pretty battered in recent years. But you see the same in the valuation of US financial assets in the stock market, which at the end of last year was trading at the highest valuation levels in history, except for the brief period at the end of the dot-com bubble. And now this year, the Federal Reserve has raised interest rates, now currently Fed funds rate at about 3.75% target to 4% target. And now you see US stock market coming down very sharply in response to a relatively small, in absolute terms, level of interest. Now, then go back to England and think about the bond market. So what was fascinating, and I think this will be studied for in financial history books in years to come, is the crash in the gilts market that occurred in September. You saw these long-dated so-called linkers, index-linked bonds, 50-year index-linked bonds, falling in value by 85%. These are gilts. They're called gilts because they're gilt-edged securities. They're meant to be as safe as houses, so to speak. And yet these bonds fell by 85% as the Bank of England raised interest rates to its bank rate to 2.25%, which is roughly just a tiny bit more than 1/3 of the post-war average bank rate. And that's enough to bring down 85% of the value of a long-dated gilt. Now, another thing that's very interesting relates back to what I mentioned of interest being the price for risk. And what I argue is that when interest rates are very low, risk becomes mispriced, and also investors will take extra risk in order to boost their income. And what it turns out is that the British pension funds, as you know, in order to, it's a bit complicated, but in order to match their current assets to their long-dated payments, had gone into the derivatives market and acquired these long-dated gilts with derivatives. And as those gilts collapsed, they then had cash calls and was then starting to have to sell off all their other assets. And there was a risk of the financial system freezing up. So one of the arguments of the book is that the very low interest rates are building up and have created an extraordinary financial fragility. And what we're seeing now is that fragility coming to the fore. And to my mind, the gilts crash is a bit similar to the problems that began to appear with mortgage subprime finance in the summer of 2007. And when I don't know if you remember, but that was the time when Bear Stearns, the late US investment bank, was running a couple of hedge funds that invested in subprime mortgage-backed securities. And over in Europe, I think it was BNP Paribas, or one of the large French banks, had a money market fund also invested in subprime securities. And that also suffered losses. And then we had these problems in the interbank market. Now, at the time, people who didn't really understand about the credit boom and subprime finance and the problems of securitized finance didn't really clock how serious the problem was. If you were following these stories, then if you actually knew what was going on in subprime and the problems of securitized finance, you knew that the Bear Stearns hedge fund was a massive sort of warning sign. And to me, the gilts, I mean, I may be wrong, but given my thesis, the validation of my thesis from the sort of gilts crash, to my mind, this is not a one-off event, but a really an early warning call.
Yeah.
Or you could see it in terms of, say, the European sovereign debt crisis, when the Greek problems with Greek debt started to appear in, I think, late 2009, perhaps a bit earlier. And it was only after a period of months and perhaps years that then sort of metastasized into a wider Eurozone sovereign debt crisis.
And you do mention the pension issue in the book. It's a remarkably prescient book in so many ways. And of course, it ends quite tantalizingly in sort of mid-2021, just as the chickens are coming home to roost. So
could I just say, I mean, I was just talking to a colleague of mine that the last chapter in the last paragraph, I talk about the crypto. I make this argument that one day we're going to have to return to find a system in which interest rates are priced priced in a market rather than set by central bankers. I mean, if we think that the Soviet Union didn't work because central planning didn't work, well, it doesn't. A capitalist system with central planners running the central bank, trying to gather all the information about working a financial system and setting an interest rate, is not really going to work. And I say, well, some people are touting cryptocurrencies as an alternative currency, and I mentioned that these cryptocurrencies seem to be sort of the crypto lenders and exchanges seem to be sort of Ponzi schemes, because they're offering very high rates. And what we're seeing this week is that one of the largest crypto exchanges, I think it's called FTX, has been has collapsed and now looks, I'm not certain, as if a certain sort of certain amount of frauds there, and that links also to the rate of very low interest rates, because it's out somewhere. Do you remember J.K. Galbraith's famous comment in his book on the 1929 crash, that during booms you get what he calls the bezel, an illusory increase in wealth, or in fact embezzlement, that takes place during the boom. And I think that and Galbraith doesn't link this to, in a way, anything wrong in the monetary system. He's a Keynesian, and Keynesians on the whole don't, to my mind, have a sort of deep interest in what interest does, so they don't really understand it. But anyhow, you take the concept of the bezel and put it through, from my prism, then you see that actually the bezel is likely to grow, most likely to grow, at a time when interest rates are very low.
Yeah, and you mentioned the various cryptocurrencies as examples of the kind of investments people make when they can't get much return from other things. What do you think is going to happen next? Because it doesn't seem to me like many lessons have been learned. It seems that even the enormous amount of money printing during COVID is being dismissed, and the inflation we're seeing is just being blamed on the sanctions on Russia and supply side problems. I have a feeling that the Bank of England and other central bankers are just going to try and get the show back on the road. And as soon as there's a sign of recovery or inflation coming down, they're going to just reduce interest rates again, maybe do some more quantitative easing. Is that what you think is going to happen, or do you think there will be a reckoning now?
Well, I mean, I think that's what the central banks think, or at least that's what they say in public. That I mean, they obviously got it wrong a couple of years ago when they said, interest rates are going to remain lower for longer. Then a bit of inflation came along, and they said that the interest rate was going to be a temporary, inflation was going to be a temporary phenomenon. And we won't get into the whole argument of why inflationary forces might be have taken a profound turn in the last few years, and that therefore the disinflation or the low inflation we've seen in the last 25 years is probably gone. But what I think that what has changed is that the central bankers are beginning to realize that the point we've just been talking about, that as you raise rates from very low levels, you are uncovering this financial fragility. Now, what the Bank of England does doesn't really matter. What the Federal Reserve does, because the US is the US dollar is the linchpin of the global financial system. The Fed is much the most important actor in this field. And the Fed at the moment is raising interest rates to control inflation, but also to sort of get back its credibility. The danger is that if they continue to hike, and some people thinking that Fed funds rates going up to 6% next year, they continue to hike, that more of these sort of gilts, crashes type events emerge in the system. So you could move, in fact, if the central banks unwittingly induce a financial crash, you could move actually from inflation to deflation, almost on the spinning round in very short period of time. The danger, and we don't know actions that have yet to take place, danger is that central banks then do return to more and more quantitative easing, or whatever you want to call it, by basically trying to calm the financial markets by buying securities. And the danger is then they have to issue more money, and the confidence in currency starts to collapse. And that's not my view alone. There's last week an investment letter was written by Paul Singer, who's one of the most successful US hedge fund managers, and he envisaged a world in which central banks can't stop themselves from printing money to support the financial system, and that in the end leads Singer to a hyperinflation. Now, we as I say, we don't know what lies in the future. Nothing, in fact, is inevitable. But go back to the book. I have a chapter on John Law and the Mississippi bubble, and I argue that Law, who created, introduced the first fiat money, paper currency in Europe, in France in 1719, how he lowered interest rates, flooded France with his paper money, initially had an asset price boom like the one we've seen in recent years. And then inflation came, and Law had to then choose between pursuing the continued policy of inflation by continuing to put money into the system, or to take a deflationary route and withdrawing the money from circulation. And in the end, Law actually chose to withdraw the money from circulation, which caused a crash and in the end, the collapse of his monetary experiment. So I think we are on the point where the central banks have to choose between inflation and deflation. And my hunch is that they will go down the inflationary route, and not least because governments won't want to be left paying very high interest rates on their debt.
And also, it feels to me as if people sense that, inflation's the stealthiest of stealth taxes, and people kind of accept, even now when inflation's over 10%, it's kind of in the background in a lot of the economic discussions. Whereas if there's any talk of putting up interest rates by 0.5%, suddenly you get all the mortgage holders saying, this is outrageous, I'm going to be paying another £300. So I suspect you're right, that they will stick with the inflation because people seem to notice it less and accept it more as a kind of law of nature rather than something that's been the result of policy.
Yeah, do you remember? So at the beginning of the book, I referred to this figure called the so-called forgotten man, an idea created by a 19th century American writer. I can't remember his Christian name, Sumner. And so the forgotten man is the person who sort of suffers in silence from policies, not represented. In a way, my book is in a way the forgotten man, or people or families, households who suffered from the low interest rate policies. And these were, the young, the workers facing low productivity, people who didn't have financial assets.
And savers, of course. Nobody ever talks about the savers when interest rates go up.
They're the forgotten men. Now, move into an inflationary era, then you get a whole load of other people also who are, who suffer from inflation. And the people who benefit from the low interest rates, or whether they're low in nominal terms or low in real terms during an inflation period, the people who benefit from low interest rates, whether they're governments or home buyers or banks or financial entities, they're the ones who get their complaints on the front page of the newspaper. And I think I mentioned somewhere that, see, you remember the Turkish president Erdogan complains about what he calls the interest rate lobby in Turkey, pushing for higher rates all the time. I say, if an interest rate lobby existed, it's always been one for much lower rates, and Erdogan himself was its chief representative.
Yeah, right. Your book's been generally very well reviewed, although I noticed that Martin Wolf at the FT wasn't so keen. I suppose he's a kind of a standard bearer for this new orthodoxy. One of the accusations he lays at your door is that you're basically a liquidationist, and that the only alternative to the status quo of low interest rates and QE is a depression, and therefore you're in favor of a depression. How would you respond?
I mean, you know, I incline more towards the economics of Friedrich Hayek, and Martin Wolf inclines more towards those of Keynes, and you know, Hayek was accused of being a liquidationist in the 1930s. The point is, if an economy is far away from equilibrium, then one has to find some way of moving it back to equilibrium, even if that means that businesses that have engaged in, if you will, disequilibrium activities, for want of a better word. I mean, look, let's call them zombie companies, or let's call them sort of pie in the sky venture capital businesses, or let's call them crypto exchanges. These businesses are a symptom of the disequilibrium. And in order to get back to a state of equilibrium, there is no choice that capital and labor must be reallocated. Now, you know, call that liquidation, if you will. The alternative, and of course this is why Martin Wolf didn't like my book, is to move further and further away from equilibrium, which is what we've done since the 2008 financial crisis. Now, of course, why the central bankers won't address my book and why Wolf won't like it is that in the end, if my analysis is correct, those who pursued and those who've advocated such policies over the last 13 years will in the end be held responsible for the problems that emerge. So there we are. That's a different disagreement. I think, you know, Wolf pointedly doesn't mention well, first of all, he doesn't mention any of the problems that I elaborate on, the causes, on the product, on the outcomes, the consequences of these ultra low rates. But I specifically, towards the end of the book, have a description of what happened in Iceland. And the Icelanders, after the global financial crisis, where they'd been the most, you know, irresponsible of all countries in the world, building up massive foreign debts, massive mortgages, so on and so forth, they actually were sort of hung out to dry. And they liquidated, if you will, they liquidated their banks, they liquidated and defaulted on their international debts. Okay, so that wasn't a nice position to be in if you'd lent to an Icelandic bank. Well, too bad. You made a bad loan and you took the loss. So then they protected their domestic depositors and they protected their home buyers on mortgages. They allowed interest rates to rise, and inflation came along, but it disappeared. And within 7 or 8 years, Iceland had recovered faster than any of the Eurozone countries that had pursued the type of policies advocated by Martin Wolf. So, and actually the economy had liquidated, if you will, by moving away from finance towards high tech and towards tourism. So the economy had restructured itself, and the government debt was down, households were better off, and then Iceland was sort of winning awards of being the best place in Europe to live. So it's simply not true that you actually have to have high and sustained unemployment as the only alternative to these type of policies. They sort of, you could say, okay, Iceland's a small country, very difficult for a large country to actually rearrange its debts after a crisis, but it is an alternative.
Yeah, I mean, there is such a thing as a business cycle, and we spent a very long time trying to pretend that that there isn't, and that recessions can be indefinitely postponed. I'm afraid our time is up. Thank you very much indeed for joining us. Great talking to you. I recommend folks at home, please go out and get The Price of Time. Absolutely splendid book. Thanks for watching. We'll be back in a couple of weeks with another great guest. Thank you in particular if you're an IEA donor. If you'd like to become an IEA donor, go to iea.org.uk/donate. Take care, and you'll hopefully see me next fortnight.
Well, if you enjoyed that conversation, why not watch one of these other videos? And while you're here, remember to hit the subscribe button and the notification bell. That way, you'll never miss out on a single IEA broadcast.